Okay. Why am I using my phone to do this? Just let's see. Why am I using my phone? Okay, okay. All right. So, with Elliott wave theory, the things that we're going to start with, I'm just going to give a quick, brief overview of what it is. It's based off of this golden ratio spiral. That's where it comes from, which is in literally everything. Um, it's in the Mona Lisa, it's in your shells, it's in your flowers, it's everywhere. Okay, and it's like in your universe. It's literally the way everything works. Okay, so the reason why I say that is because it's based around Fibonacci. Okay, and the Fibonacci retraces. So this website that I sent inside of the chat in the Discord, it basically gives you a rundown on everything that you need to know. We're gonna skip all of this bullshit here, okay? We don't really need to know who Elliot is or anything like that, but we will click on this one, okay? So the wave degree is somewhat important. It works on a fractal nature, meaning that while one wave is going on, there can be a wave within that wave as well. So on just like on your time frames on your candles, you have your 30-minute time frames, and your 30-minute time frame will show you here, let me clean this up so that you guys can see. So I had these boxes here prior to the market reaching them, and so it made it pretty easy to get a nice long-term short. I have May 16th puts that I bought. Once we broke this low, I knew we would get a bounce, and so I bought them right around 471 is where I bought them. It was on April 2nd. I knew we had tariff news, but beside the point. Main point, what we're talking about right now is the fractal nature of Elliott wave, right? So 30-minute candles, there's going to be a wave count, and then if you were to go into 1-minute candles, you'll see another wave count. And it doesn't mean that the 30-minute candle doesn't apply. It just means that you have a wave count within a wave count, and you can have wave counts within a wave count within a wave count. So you got to, that's why when I say something like we have a wave three of three, I'm basically saying, and sometimes I'll just simplify that and say we're in wave three dash three, meaning third of a third. Okay. Um, so that's kind of like what I'm talking about. We got some fractal natures, okay? Second thing we're going to talk about is you have your impulse waves, and then you have your corrective waves. They call them motive waves here, but if you use this trading view platform, it comes pre-built in with the Elliott waves. They call it impulse, and then you have your corrective wave. It's self-explanatory pretty much. Your impulses are going to have 5 waves like that. And within those impulses, you're going to have the impulse of 1, followed by a corrective wave of 2, impulse of 3, corrective wave of 4, impulse wave of 5. Okay. And that'll be your impulse. And within those corrective waves, right, like I said, it works in a fractal pattern. So in these corrective waves between wave 1 and 2, as well as 3 and 4, you'll find these corrective waves, the ABCs. Okay. So that'll work in like three waves. Okay. Now, typically, what you'll see, and we'll get into this, is a little bit more advanced. We're just kind of giving a brief overview right now, but you'll typically see within that fractal nature on these impulse moves up from 0 to 1, you'll see a smaller five-wave sequence going up like that. Okay. Now, there are like little, things to keep in mind, but let's just go ahead and go through this like file that I sent you guys. So the wave degree, it's basically how you can kind of gauge where we're at. You can tell just how overinflated the market is by looking at this grand super cycle. So something that's like a grand super cycle would be going onto the QQQ, and if you were to go to like a weekly chart where every candle's a week, the grand super cycle from this is the 2000 crash, okay? Ever since the bottom of the 2000 crash, wave 1 would be up until 2008, okay? Wave 2 would be the breakdown at 2008, that crash. And then wave 3 would be all the way up past COVID even. A lot of people would think that COVID is important. It's actually not as important as people think. Okay, this is actually COVID right here. But all the way up until 2022. And then wave 4 was down at the bottom of the bear market in 2022, and then wave 5 all the way up to the top. So you can see that we're in a super cycle basically, and that's why Warren Buffett was getting scared once we had broken over these highs. That's when he started talking about easing his position. You'll see back in history that that's when he starts taking his stocks off. Okay. So let's start talking about, let's go back up to the top here. Fibonacci. Okay. So that's kind of like just a general overview. You have five impulse waves up, followed by three corrective waves down. Okay. Now, how Fibonacci ties into this, and this is a lot, so we're not going to really read all this, but we have important fib levels. A lot of people are going to tell you that the only fib level you need is the 50%. That's not true. You really want what it kind of comes preloaded with on TradingView. You want the 1.618, the 1.27, you want the 1, and you don't really need the 0.854. I just keep it there. It doesn't really matter to me. But the 0.786 you want, all of this you want. Okay. Uh, the negative doesn't really matter either. Um, So the common ones that we'll be using in this is the 61%, the 38%, and the 50%. But you'll see on these retracements here, it shows you it's showing you kind of the ones that we use, right? 14, that don't even worry about that one. That one's irrelevant. Um, and the 85 is pretty much irrelevant as well. Um, So look, this is a great section here, 2.5 inside of that PDF. So wave 2 is typically 50%, 61%, 76%, or 85.4% of wave 1. Okay? So let's see. Try to find a quick example here. Um, let's see. Wave 2, 50%. Yeah, this is a good example. Okay, so from this top here, right? One, two, and we're working on three. Three, I believe, is going all the way down. Well, not all the way down, but uh, we already broke these lows, I think, and now we're bouncing. I think we've already finished three. That's what I was saying here tonight, and now we're coming back up for four, and five will end down here. Okay, but if we take this first wave here at the top, and we take this Fibonacci tool from the top to this bottom, okay, you'll see that we came up over 50%, pretty much to that 61.8%. Okay. So, I mean, if I were to make this exact, you probably would be right on the dot. Okay. It's like pretty much right on the dot. 61%. So you'll see that it oftentimes comes to this zone. So 50% to 85.4. Um, wave 3 is typically 161% of wave 1, which brings me to my point of why on the QQQ. And I remember I showed you already that the grand super cycle since the 2000 crash, okay? So for the past 25 years, that's the grand super cycle. So keeping that in mind, that when we have the correction off of those 5 waves up, we should have 3 waves coming back down, okay? And we'll get into this a little bit later here, but within that the A wave down, I think that we have 5 waves that we're going to end up doing. Okay. That's what I'm saying. And so wave one was all that retracement off of the top there. Okay. And then we got a perfect wave two going up here. Okay. And wave two, if we take the fib levels again, it didn't quite get to a perfect, I guess, a perfect refib. But this is all part of A, so it doesn't necessarily have to be exactly 50%, 60% or higher. Okay. Um, let's see. So basically what we do is if we go over here to these tools, we use this trend-based fib extension from the top to this bottom to this next top up here. Okay. You take that, the 1.618 fib is down here. I went ahead and marked it out already for you guys. So that's where we're headed, okay? Based on those rules that wave 3 is typically that far from wave 1, okay? Going back to this again, wave 4 is typically a smaller retrace, okay? So that's why I'm saying right now, going into the current moment, why any of this matters in the first place. Remember, I called the bottom within like a couple of minutes. I think like right around here is when I called the bottom. Did that based off of the MACD reading, not so much the Elliott wave pattern. But you can see that, let's see, that's the high. Okay, so the wave pattern here is 1, 2, and all of this is 3. Okay, we're going up for 4, and we're coming back down for 5. Okay, and the way I know that is because the third wave, since we're just trying to give a brief overview real quick, is typically your largest and strongest wave. There's a rule. The third wave can never be the smallest impulse wave. So out of this 0 to 1, this 2 to 3, and this 4 to 5, 2 to 3 can never be the smallest length. Okay? It doesn't have to be the longest, but it can never be the smallest. So, and oftentimes it ends up being the longest, okay? Because it's the main move. If you wanted to put it into kind of like price action terms, this is the sell off of the top because people are starting to think that it's overpriced. And then we get a bounce because it starts to sell off and people think that buy the dip, right? Buy the dip. And so you get a bounce. And then the sellers re engage because it's now at a better time for them to continue selling. Also, you could put it as these sellers, as they continues to sell, it becomes less of a good time to sell. You would rather wait for a bounce to continue selling, right? So the sellers start to ease off and stop selling as much. So the buyers come in and they move it back up, and then the sellers re-engage once it's at a better time for them to sell, and they continue to move it down and down and down. until eventually it gets overextended. And now at this point, the sellers are looking to stop selling and the sellers are thinking about buying. But now everybody that's missed this giant move, all the sellers that have missed it, they come in and they have FOMO and they send it down to the wave 5. Okay? So that's one way you can put it. Um, but within this, like I said, there's a fractal pattern. Ugh, excuse me. You have one here, two there, okay? And then there's a third of a third that goes on, okay? So this is 3 1, 3 2, and then this was during the Trump tariff shit with the press brief and all that. That's the 3 3, okay? 3 4, 3 5, okay? So that ends wave 3. And then we should go back up according to these rules somewhere between this amount. Now, typically, I don't really use the 14% because it's not that much of a retrace. Truthfully, you want to get 23% to 38%, and that's what I say happens majority of the time. If you just do a simple Google search, it'll tell you that commonly it goes to the 38.2%. Okay. Common way often retraces 23.6 to 38.2. Okay. So that'll tell you where your zone is. And that's why I said those levels, that little box of 17, whatever it was, I posted in Discord. Because now that I'm pretty sure we have these bottoms in, okay, now that I'm pretty sure we have that in, then you can go ahead and I already know where the wave started was up here, right? So you take that retrace down to here, and that will give you your zone. Anywhere in this orange band, that's where you want to get back to. And then you can close out your longs anywhere in this area, and you can start thinking about looking for shorts because we should break this low again, which typically will probably like I don't want to make any assumptions, but it usually will happen on larger volume. So I'd say it's probably going to continue meandering around for a while, going up for wave 4. Okay. Um, I mean, it could happen late at night. I notice I don't know what session it is. I don't really trade after hours very often, but usually around like 2, 3 New York, that's when like volume will start to pick back up again. And obviously pre-market right around like 7, 8, you'll get a little bit of volume spike. So um, that's when I would expect you start to head back down and we break these lows. And I think that, it's pretty obvious to me that we're going to break these lows by the morning, and then we'll have finished the 5 waves down. So from there, we'll be looking for a larger retrace back up. Okay. Reason being is because in this wave pattern, you have 1, 2, we're going to break down for 3. Okay. And then we'll go back up for a 4 and then come back down for 5. Okay, and that'll finish wave 3 because all of this is going to be wave 3. Okay, so when we get that wave 4, this larger wave 4 on a 30-minute chart, oops, we're something like this, right? When we get that, we want to wait for that zone again, and when we break down, then you know that we're going short, and from there I don't really like to trade so much in this. This can get you fucked up because it's an overextension again. But I have a target that I'm looking for based off of the fact that I have this first wave. Okay. All right. Let's go back to like some of the Elliott wave shit. Let's get into like um the retracement waves here. Yeah, they even call it impulse in there as well. Let's go ahead and look at this real quick. But no more than 50%. okay, of wave 3. That was something I forgot to mention. So for wave 4, it's only of wave 3, right? So you're going from this high, not the ultimate high, right? You're looking for the retrace of the third wave. The same way in the second, obviously you're just doing the retrace of that first wave, okay? Mm, yeah, diagonals, we don't really need to go into that so much. See, they're kind of explaining in here the same thing that I was saying to you guys, that wave 1, you're hitting stops, right? And then or well, we stop, okay, and then we come down, and wave 3 is the initial stage. And wave 3, we hit all those stops and we do a stop run and we run higher, right? And then we start to take profit. And when we start to take profit, we decline for wave 4. And then going back up for wave 5 is just the overextension. It's the FOMO, the people that feel like they've missed out, they want to buy in. And so that's again why I don't know how much I'm going to be trading tomorrow because it's just the FOMO, the fear of missing out. But there is the fact that it is the third wave of a more large wave. So I'm already in puts, so I might as well just do nothing and coast. But if there's a good opportunity, there's a good opportunity. Um, So this is really the bread and butter right here. Okay, the corrective waves. So your corrective waves, you have a zigzag pattern, you have a flat pattern, and you have a triangle pattern. Those are your three. Okay, the double three and the triple three is just simply a combination of these three. Okay, so you can have, um, you know, wave A, wave B, and then wave C is like another one of these, basically. Okay, but it'll show you right here. This is really, I think, the most important part of the entire document, the corrective waves. It's going to give you more information about wave 2 and wave 4. Okay. And that's going to help you get in when it is time for us to start moving up. Okay. So you have the zigzag, which when they say it like this, 535, they're saying that there's 5 waves down for A. There's 3 waves back up for B, and then there's 5 more waves down for C. And a zigzag ends diagonally down. It ends downwards. Okay? So, something I want to bring up to you guys is that it is a possible wave count that this is a big zigzag, right? We have 5 waves down to here, 3 waves back up to here. And once we finish this wave count and we come down to this extension, which is where I'm kind of expecting it to go to. It doesn't have to go there. Once we have that, it could be over. The bear market could be done. And what they're saying on the news about there isn't going to be a recession, that could be possible. That this is the end of the bear market and then we head back up to new highs. However, for the reasons that I was showing you on the weekly chart and that we have this grand super cycle, I don't think that's what the case is. Okay. I think it's going to be much longer and much more pain to come, but we will still get a bounce. Okay. Because either way, this is wave 3. We'll get a wave 4 bounce and then we'll break this low. That'll be the end of wave 5. And then you'll have an ABC back up. Okay. So, my theory on this bear market that we're going into is that we're in a ginormous zigzag pattern. Okay. And we have 5 waves coming down and then you'll get a bounce and everybody's going to pile in. You'll hear on the news, they'll be like, oh, buy the dip and all this stuff. And it will be a good opportunity to buy the dip because B can come up quite a bit. It doesn't really have, well, I guess it has a ratio here 50% to 85%. But like I said, I don't use the 85. So 50 to 76.4% is what we'd expect. So coming back off, if If I show you that, if I'm correct and this is where we bottom, uh, if that's where we bottom, then you could come all the way back up to 457 to 500 on the QQQ, okay? And that would take you back to those lows that were in January. So it is quite a bit of a rally, and so there is incentive to put your money in on that dip. And like I said, this could just be a ABC down, and from there you're done, and we go back up to new highs. So there is going to be a lot of incentive for people to buy when we're down there, and it would make sense for you on like a longer term, like at least I don't know, 3 or 4 months, to probably put your money in when we get down there, because well, once we have 5 waves down, this is only 3 waves, right? So then we'll get a wave 4 bounce of this entire thing. So assuming assuming I'm right, then this would be you'd be getting up to this range, 413 to 437, okay? And then you'd break that low one more time, and then from there, that's when you'd pile in, okay? And so if you're like a long-term investor, that's what you do. You wait until the 5 waves are done, and then you put your money in. Okay, so now that we have the zigzag kind of figured out a little bit here, I'm gonna leave these rules up so you can read them real quick. It's basically just wave B is 50 to 76.4%, and then wave C is usually 61.8%, 100%, or 123% of wave A. Okay. I oftentimes see that I think the most likely scenario that you get most of the times is that the A wave is equal to the C wave, so it's 100%. Okay. Um, I want to try to see if I can find an example in here. Oh, it looks like we broke the lows. Interesting. I mean, there's really no end in sight. You have to use other things for indications, but B waves can come down and break that A wave start. So it is still possible that we're going back up here, and it's not necessarily going down still. Okay. This could just be wave A going up, B, and then we're going to go up for C. Okay. So the 1, 2, 3, 4, 5. Yeah, so you could have 5, and then 1, 2, 3, 3 waves down, and then you can get 5 waves going back up, right? You get what I'm saying with the zigzag. So it's still possible that that's going to be the actual low, okay? But that's typically why I don't do anything on wave A. I'll always stay out until I have confirmation. And so if you see a bottom here and we start to move back up and you start to see like a wave 1 and a wave 2 and the wave 2 holds that low, then I might think about buying, okay? The first move's never the real move. Okay? So anyways, that's the zigzag pattern. It's a 5-3-5 combination. Next one is the flat. It's a 3-3-5. So instead of 5 waves, it's going to be 1-2-3, and then wave B again will be 1-2-3, and then the C wave will be 5 waves down. Okay. Now there's a couple of different flats within the flat category. There's the regular flat, and the reason why it's called a regular flat is because A comes down to this point, and then B goes back up, and then C comes back down to the same level as A. They just basically double bottom. Okay, that's a regular flat. Um, Shows you right here Fibonacci ratio. The wave B goes 90% of wave A, so it goes pretty much all the way back up, and then comes all the way back down. Right. Um, Wave C goes up typically or wave C goes 61.8, 100%, or 123.6%. Okay. So in this case, with the regular flat, it's going to be 100%. For an expanded flat, it's still going to be a 3-3-5 pattern, 1-2-3, 1-2-3, and then 1-2-3-4-5, right? But on the expanded flat, the C is now going down 123%. Okay, and it can go, as you can see down here, 123% or 161.8%. Okay, anywhere within that range. So you can get an expanded flat, which I think. So that's what I was calling for this morning. So there was a few people that were before me looking for shorts because they were looking for a double top up here. Okay, and it did come down, and I said I think it's going to squeeze one more time this morning. Right, it's going to try to squeeze those people out, and I thought that we were going to try to break the high from the fake news event. Okay, we actually just ended up double topping it, and we didn't even break the high. So this would be considered. Let's see. This would be considered because this was all part of wave 4 of 3. Remember, it's wave 3, 4. This would be your 1, 2, 3, 3 waves up, and then you'd have wait, 1, 2, 3. No, no, no. Hmm. 1, 2, 3, and then gosh, I forget how I counted this. It can be very complicated when you're looking at these retracement waves. Trust me. It's very complicated. But when it's the impulse moves, it's almost very obvious to most of us. Um, so I wouldn't really worry too much about the corrective waves for right now. But so we got pretty much a flat here, and then we ended up going back down. There's a 3 wave, and then another 3 wave, and then a 5 wave. That's what it should be. So 3 waves, and then 1, 2, 3. That's what it was. Okay. So it was A, B, C, 3 waves up. Okay. And then from there, it was 1, 2, 3. That's B. And then from there, the C was 1, 2. The 3 was to the gap open. So I guess the gap open, so it was there. Okay. And then the 4 was down to here. I think. Yep. Yep. That would work. And wave 5 up to there. Okay. And as you can see, wave 3 is not ever the smallest wave. Okay. That was what the wave pattern was. And that's a normal flat. Okay. Not an expand. That was the normal regular flat. That's what we had. A little bit hard to see. I know. You're not going to get a pattern like that very easily right from the start. But as you do it more and more and more, and you develop an eye for it, you'll start to kind of catch on, and you'll be mid process, mid wave count, and you'll be eliminating some counts because they no longer can occur, and then you have more clarification on what it really is. One more thing to kind of mention before we move on to more corrective wave stuff. So wave 1, 2, 3, 4, 5. So wave 1, this high. Wave 4 cannot come into wave 1, okay? So it can't break this high. That would be invalid, okay? Wave 4 has to stay above wave 1, okay? If it comes down, invalid. Valid, invalid, okay? For wave 5 to be valid, it obviously has to break over the high of 3, right? For wave 3 to be valid, it obviously has to break over the high of 1, okay? So that's something else to keep in mind, guys. Something I didn't mention, but I probably should have mentioned a lot earlier. So 4 stays above 1. Within that, this was 1, 2, 3, and then 1, 2, 3. The reason why it's not like this, 1, 2, 3, 4, 5, is because 4 goes into 1. So that's invalid. Okay. So you'd have to, if you wanted to continue this count, this 335 expanded from here, and you don't know any other data, I'm assuming you only had like this, right? You'd have to assume that this is just a pullback, and really what's happening is that we have 3-1, 3-2, right? And then going up until open, or no, till here was 3-3, okay, 3-4, 3-5, and then pull back here for wave 4, and then 5, okay? So yeah, it gets complicated, obviously, with the corrective waves, but that's your flats. Okay, so your expanded flats, like we were saying, is when your C actually comes below or above in this case, since we're in a bear market, right? And we're looking at this pullback back up. Um, it's basically back above the A, okay? And it ends in a diagonal. It can be confusing and it can look very similar to this zigzag, since we in both of them we go down and then we break wave A's low for wave C. But the difference is that a zigzag has 5 waves down, 3 waves up, 5 waves back down. Okay. So the flat only has 3 waves down on the first one, 3 waves back up, and then 5 more waves back down. So it's a little bit different, but um, that's basically what happens. So for running flats, it's kind of the counterintuitive to what the expanded flat is. So the expanded flat goes down and breaks that low of A, but the running flat stays above A. Same thing though, it's still a 3 wave sequence, a 3 wave sequence, and a 5 wave sequence back down. 335. Excuse me. And feel free, of course, to read more about it. I'm not going to go too much more into it. It's pretty clear. Um, the main thing you just got to grasp for the basics is just these numbers here. So the zigzags of 535, the flats at 335. Then you have your infamous triangle. Now, most people have heard of a triangle before, but they're not aware of an Elliott wave triangle, okay? Where you have 3, 3, 3, 3, 3. Okay, so you have 5 waves within a triangle, which we all kind of know. Okay, there's A, B, C, D, E. Okay, that's what they do. That's 5 waves. So one, 2, 3, 4, 5. And then within each of those, there's going to be three. So there'll be 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay, and then we break the triangle. Um, let's see, going back, triangles. So there's a lot of different triangle patterns, okay? In a bull market, you have your ascending types with the top where it's flat and the bottom is rising, okay? And in a bull market, as you can see, when we break over that flat line there, it goes up, okay? The same applies in a bear market, though. You can have the same thing, but we came into the triangle. This is the thing about triangles is we wanted to assume this is it's not a triangle, but let's just say it is. Okay. Um, we came into this triangle to the bearish side. Okay. if we come into it from the bearish side, coming down like that, and this was actually a triangle, it's not an actual triangle, but if it was, you'd expect this to break back down, okay? And so that's what they're showing you in this graphic here. See how we came into it coming down, and we come into it and we break down. We come into the triangle going up, and we break up, okay? So that's the rule, the way that you come into the triangle. Now you'll see here we come down again, same thing, same thing, same thing, no matter what. So descending top and a flat bottom, that's a possibility where B is higher than D, okay? And this is, I don't really use this at all. I'm not like really super familiar with it, but this XABCD pattern thing, right? It'll kind of show you it's based off of Fibonacci as well, but it'll show you like whether or not your A is higher than your B or your D, whatever the fuck, you know. Um, but there's like rules to this thing too. I don't use it. It's too complicated for me. I'm only so big brained. Um, but yeah, then you have this is what they call on Top Step X or the Top Step TV. They call this the megaphone. Okay, the megaphone is a triangle. It's not a. It's the megaphone is not a some like arbitrary pattern. It comes from Elliot wave. The megaphone is just the same thing. And we actually I think had one today if I'm not mistaken. Um yeah, I think this is you'd have to go into 100 ticks, I think. But I think in here I'm pretty sure that's your megaphone triangle. Okay. So, you have your A is going or D is going to be higher than your B, C will be higher or lower than your A, right? So this is A, B, C, D, E, and then we come back up to the midpoint and we fail, obviously, because we're not going back up. Although when this was happening, this is where I took my short, by the way, my 0-day expiration put. I think I bought my first one over here at the lows, and then I bought my second one when we crossed back down on these EMAs over here. And I just had two. I didn't really feel like buying a whole lot. Um, but yeah, so then we broke down from there because we obviously came into that triangle coming down, right? And when we break down from there, it's history. It just from there at that point there is no longs pretty much. But you can know for sure that there's no more longs. And this is when I was in the chat today explaining to people that the longs are confirmed not to be true anymore. When we came into this consolidation zones yesterday, like I was showing you in that wave count, this zone had, remember, this is 1, 2, 3, 1, 2, 3. So this was wave one, right? So if you wanted to say that this was wave two and this was 3, 1, uh, this was still valid, okay, until we crossed down like right around here. This was when you had the invalidation of all longs, okay? Was because when we came up, you could say that this was wave 3, 1. I'm sorry. This is wave 3, 1, 3, 2, and then we were doing some sorts of expanded 3 and we were just coming back for a wave 4. But as soon as wave 4, right, or you could say that this was wave 3 and that this was coming down for wave 4 and that we would break the highs one more time, right? That was a possibility until wave 4 came and broke beneath that wave 1 low down here. From at this point, you should have only been looking for shorts. There is no pattern anymore. There is zero patterns left. at this point. This is what I'm talking about, how Elliott wave is very useful. There is zero patterns left that are saying that it's in a bullish trend. Because once you break that, there is nothing left. Okay? There is only shorts at that point. So then I was just simply looking like if I was my top step got fucked up. I don't even want to go into it. It was complete bullshit. This is a combine. If you look at these profit losses, I stopped at $1,500 for some reason. I The next day when I come into my account, it's up 3,500. I had to contact support and some more shit. They said it could take 2 days to resolve. At that point, the fucking entire move might be over. And then I lost my XFA today, which I'm pretty sure I'll get that back as well because at 10:45, my fucking top step literally just goes, "The markets are closed." And I'm like, it's fucking 10:45. What are you talking about? And then 2 minutes later, it goes, the markets are open. And I'm like, what the fuck? And I was in a position when the markets said that they were closed. I had to take profit. I had a stop loss. It hit the take profit, but it didn't fucking execute. And then it came all the way against me. It hit my stop loss and it didn't execute, and now I'm down $1,600. And I'm like, what the and it executes for minus 1,600. And I was like, what the fuck? And so then I ended up losing another 400 and that was my own fault. But like, bro, I was like, are you fucking serious? So I don't know. I'm pretty sure I'll get that back as well. But like, it just pissed me off because this was such an easy move, and when we had that invalidation here, when we pop back up, I have EMAs on here, the 1021 EMA on the 1 minute. We popped up to this 21 EMA. That is such a perfect fucking short, man. That is a perfect fucking short. When we come back down underneath of it, it is just clear as day. And so I would have definitely taken that. And I would have rode that shit for, because then, at this point I'm looking and I'm counting waves down. And so I'm like, the wave four, because I know that all of this was just part of a bigger wave four, right? I know that we were going to break the lows. So it's like, I would have probably just held to the end of the day, or at least till MOC, and so I would have made a shit ton, 749 down to fucking 19, like something, 1980. Right? If I had gotten out right before market on close, because I knew market on close was probably going to move the market back up too. But if I got in right out right before that, that's like 500 points. That's 10K. Because I always trade 10 micros. Fucking 10K I would have made, dude. And then of course if my XFA hadn't fucking messed up, dude, it's just it all fucking pissed me off. I was very upset. So that's why I was in 0 day expiration puts today for that reason. I wouldn't have even been trading the puts, but because I have my May 16th. So it's like, why would I even worry about some shorter term? It doesn't make sense. I'd rather just focus on the futures and stack this, but I couldn't. So I was like, fuck it, I'll just do that instead. But anyways, um, so you have your triangles. Going back to the main point, I'll get sidetracked a lot. Um, is this going to be recorded? I don't know. I didn't start recording it, but maybe I should have. I don't know. Honestly, dude, you can always just go and read this, and I'm showing you don't really need to read the entire document. The main sections that you need are literally just this corrective waves is very important. And then, some of this stuff can be useful, but this is just talking about personality and as to like price action, why it's actually doing it. And then, you know, some of this stuff is really not important at all. This stuff I'd say is important, but you can just Google this stuff too. You don't have to read this shit. If you're like, oh, I forget, because I forget all the time sometimes, like sometimes I won't remember that, like which one's which. Like for some reason they'll get mixed up in my brain, and I'll be like, was wave two the one that's supposed to go 50%, or is wave four the one that's supposed to go 50%? So I'll just look it up on Google and it'll tell you. Um, but at this point I figured it out. you know. But when I first started. doing Elliott wave. That's what I often had to do. Um, I've been doing it for more than a year now, and my dad's been doing it for several decades now. So talking to him about it, he's the one that'll sit here and spot like the fact that this is a three wave sequence going up. Okay, and so if it's a three wave sequence going up, it can only be a triangle or a flat, because the if it was a zigzag, it'd have five waves, right? So, but there's only three waves in here, and so he's like, it's either going to be a flat and it's going to double top that high. That's what he's telling me, or it's going to be a triangle. And it's just going to consolidate. And he was right. He was thinking it was a triangle until he started to see that there was no triangle forming because we broke back up to the top side. When we broke up to the long side here, it should have broken if it was a triangle. Well, I guess it still could have been a triangle here because it did come into the triangle on the bullish side, right? But actually, no, I take that back, because even though we came up this way, um, actually, yeah, I don't know. The triangle doesn't really make sense to me, to be honest, because your triangle would have to be drawn like this from the bottom to the top. It just doesn't really make sense. But he was more or less saying it could be a triangle, but he was thinking it was the flats all along. He was right, but anyways, but you don't really necessarily need all of this stuff. You just need the few categories that are kind of important. Um, But the triangles, they happen in the 5-3 waves, okay? And you don't see those as often. I'd say, like, I mean, this is just like a guess, but I'd say 70% of the time you get the other ones. You get the ABC with the running flat, or you get the zigzag. I'd say majority of the time you get a zigzag. Um, but like, I'd say it's probably like 40% zigzag, 30% flats, and another 30% the triangles. That's what I would guess, but I don't know. Very rarely do I find double threes or triple threes. Because those are typically, I think, on bigger time frames, and most of the time I'm looking at like 1 or 5 minute. Um, but you might be able to find something like that in like a bigger wave count like this. When we end up coming down, it's possible that we do like a double three of some sorts. Um, and that's pretty much it for this document I sent. So pretty much Elliott wave is combining the fractal nature, the golden ratio. The golden ratio is how you get these Fibonacci levels. Okay, if you didn't know that. These Fibonacci comes from the area within the square. Okay, so 1, 1, 2, 3, 5, 8, 13. And if you keep going on, and then you take the ratio between 13 divided by 8, that'll get you those percentages. Okay, so that's where that comes from. Um, and it works on a fractal pattern. So there's larger waves and there's smaller waves. And so you can have what I oftentimes say is a third of a third. And when you find those, something, a little side note here, like I said, the third wave is typically your longest wave and it's usually your strongest wave. Okay. This right here was your third wave of a third wave. Okay. Because all of this, like I was saying, I think is wave three. Since it's all wave three coming down. So then 3-1, 3-2, 3-3, right? And you see how fast it dropped compared to here. There's green candles every once in a while, right? Here it's just straight fucking down. Okay, and I think this, if we were to go back and we were to look, let's see. Um, where is it? This is saying 12:56. 12:56. Nah, this is way later. 3 o'clock. There was something going on. This might have been during the press conference when they were talking. Um, but that's just it. It correlates. The markets are oftentimes faster than what's happening, and so if you can really read the price action and really understand, you can kind of predict when crazy shit's gonna happen in the world. Like I predicted back in August, I predicted that we would have the yen. I didn't know that that was gonna happen. I knew something was gonna happen. I said on Friday, the prior Friday, I said that on Monday we will gap down largely because it was basically the end of. Is this August? Yeah, that's August. It was basically the end of this. Okay, you had three waves, and you had one, two, three, four, and we were just trying to gap down and finish so that we could start rallying. It's pretty clear to me, but like I don't want to get too far deep into that. But there was also another reason. It's because this level here that we came to, exactly where we came to and started buying from, is Illuminati Day. So if you go back, Illuminati Day is May 1st. Okay. May 1st is when the Illuminati was founded. A lot of the times, I have a friend who's born on May 10th. So it's the same numerology as May 1st. Okay. And they basically hit her up and they were trying to get her to join the Illuminati solely based on the fact that her birthday aligns with um, the Illuminati Day. Okay, the day that they were founded. So they believe in like all the gematria and all that bullshit. But May 1st, you can see here, right? This low, 420.60. Okay, hold on. This is on a 30 minutes, so May 1st. Gosh. Like right around here is where they started to buy. So basically the Illuminati, they were fucking buying and trying to support their position. Because I promise you, they care so much about the date, just the date alone, that they will put more money into the market based off of just the date. Okay? Just the fact that it is May 1st, they go in, it's like their birthday, you could think of. Like on your birthday you celebrate, right? If you're the Illuminati, you have a bunch of money, right? So you're like, "Well, let's celebrate. Let's buy some stocks." And so they jack the price up on May 1st, right? You can see we start the next rally after this dip that we had. Okay, and so we came down here. And that's why I said in the chat before, I even said it. I said on May 1st, watch for something to happen. And it'll probably be a buy because the Illuminati has a bunch of money. And like I said, they're trying to celebrate. It'll probably be a buy. So May 1st, by May 1st, we could be down here. We could have finished wave three and then you could have a buy. And that could start wave four. Okay, and that could go all the way back up to where we're pretty much at right now, like right around here, 420-ish, 427. Okay. And that would be kind of retesting your break from the August lows. So we come down here and we come all the way back up to 427. You'd be retesting this break. Okay. And then from there, you can come back down. That's what you'll often see if you aren't aware. I'm sure like you've probably watched Dakota and stuff like that. Um, when we got this break here, right? You come back and you retest it before you head lower. Doesn't have to stop exactly at that point, but you almost always want to come back and retest. Okay. So like here, right? We break the lows and then we come back up and we retest to see if we're actually trying to break. Okay. Break the lows and then you come back up here. So like the other one, this one right here is retesting this break. Okay, so they retested that and then we came lower. We break this low, come back up, and then we go lower. It's just a common thing. They want to make sure it's not just an overextension and oversell. And a lot of people sit there and they're like, "Oh, buy the dip. It's cheaper than it was in January. It's cheaper than it was." And so they'll keep doing that. And so we actually did break one, right? You'll see right here. This was the April, I think, right? April, yeah, April 2024. We broke this low, and then we had the fake news event that comes back up, right? So, and now we're coming back down. And once we break that low again and we break this low, then everybody will know. And then your next real support, because this is a very small dip, okay? Your next real support then is going to be like right around here, the highs of this coming down, right? And I'm sure this probably has a zigzag or 1, 2, 3. So you 1, 2, 3, and then 1, 2, 3, and then you have 1, 2, but that can't be the right count because, like we were saying, if this were going to be like that, that wouldn't make sense because four comes into one. So that can't possibly be the count. So examining this, again, this could be 1, 2, 3, and then it can't be four like this either. So it can't be like a zigzag like that. So I would assume this is probably some sorts of triangle. Okay. You probably have W or 1, 2, 3, 1, 2, 3. That's two. 1, 2, 3. That's three. 1, 2, 3. That's four. 1, 2, 3. That's five. Or maybe even like that. Okay. Now you have your triangle. Okay. And again, even though it doesn't look like a triangle, which you know, I know what you guys are thinking. This is probably a bear flag, right? That's another name for it, basically. Okay. You could have this bear flag where you have a parallel channel. Once you break out from that parallel channel, you go. Okay. And now the key thing that kind of I wanted to bring up here is that this 1.68 fib lines up. It makes perfect sense because again, I showed you how we got that 1.68 fib. We took this, right? I just really roughly did that, but you do that extension and you get the 1.68 fib. But when we broke out of this support here, okay, you start squeezing these shorts. So the shorts that came in here, right, we came back up and we kept them in. We came back and we went lower. We came back up and we kept them in. We kept them going down. But once we break over one of the previous highs, you start to get a short squeeze, right? And so these people are going to start covering their shorts, and that's going to start to move the market up even higher. And then once you break these highs, again, it's going to squeeze those people up even higher until you eventually break over these highs, and then it's going to squeeze it up even higher, right? And so basically, what I was going to say is that this 1.68 fib lines up to exactly where you squeezed out those first shorts, okay? And so we never really came back and retested. You'll see here when we squeezed out of these shorts at the tippity top, right? We came back and we retested because this is originally a resistance, right? That's a resistance. And then when we break out, we want to see if that resistance is going to hold as a support, right? Or some people call it a cup and a handle or whatever you want to call it, right? Like so that's basically what I'm saying is we never really came back and retested it. You could say we retested it here, but like this is a very, small amount of time for a proper retest. Okay. So if we came back for a 1.68 fib, we would come back to that point and retest that support level. So it's just another thing lining up. It's giving you more and more confluence, more of an image of where it's possible that we go. So if I don't, I just want to kind of give you guys a quick freebie from the more experienced um, look of things, right? I again said to you guys, I don't think that this is going to be the end. I think we'll have four and we'll break back down even further to five. Okay. Now, all of this I told you was part of a super cycle. We've already had the five waves up. And so now, after the five waves, you get an ABC. I don't know if I even mentioned that earlier, but the ABC comes after the five waves. So once you have uh, 1, 2, 3, 4, 5 up, then you get the ABC, and it can retrace all the way. It can retrace 50%. It can do a couple of different things, right? So on the super cycle scale, we've gone up the five waves. So all of this bear market's going to be part of a retracement of some sorts, an ABC. And what I expect is going to be a zigzag, okay? Although it can still be two different things, right? It could be a zigzag, it could, or I guess it technically could be three different things, right? We still don't haven't had a clear situation yet. Okay, but what I am expecting is, since it's on the super cycle scale, I would imagine that this is going to be a zigzag, and that this five waves here is going to be your A, and then you'll have a larger wave B, and then a C that really takes you down. Okay, and everybody's going to panic, and they're going to be panic selling when we break these lows from down here. That's when they'll really panic sell. And what I'm imagining is that we'll come back to the COVID highs. Okay, my dad, he thinks we're going to the COVID lows. Okay, so this red line here, this dark red line, is connecting your past two crashes. Okay, your past two major crashes, I should say. So you got your COVID crash, and then you have 2008. You had the flash crash in 2000 and like whatever it was, 2015, but I don't really count that because that was just a glitch in the system. There wasn't really like an economic reason why that happened. It was just a glitch. Okay, it was some autistic guy in somebody's basement who found a way to basically cheat the algorithms. And he cheated the algorithms and crashed the market for like a minute or two. He made billions, I think, of dollars, millions of dollars, hundreds of millions, whatever it was. So I don't really count that one. But obviously, there was economic turmoil during COVID. Obviously, there was economic turmoil during 2008. Okay, so if you connect those two crashes, if this is going to be some sorts of, let's say, tariff crash, although the truth of the matter is that the macroeconomics of it is more of a debt crisis crash than anything. Um, but if you were to connect it and you take it to that trend line, right, you could, if you were to come by like 2026 January, okay, and markets typically like to bottom right around October. Okay, Octobers are usually when markets like to bottom. That's where you could bottom, right? You could go right there, straight to the bottom, and you'd be done. And you go back up, and you start a whole new five-way sequence. But the thing to really look at, because there's a lot of parallels between the market right now and the dot-com bubble. Right now we have an AI bubble. The dot-com bubble back here is very similar. All of this would be your wave A, okay? Coming back up, everybody thinks the market's recovering, right? We went back up, that's B, and then C really took out the fucking floor. Now this is the QQQ, so it doesn't exist prior, but if you wanted to see prior data, go to the NDX. It's basically the same thing. Um, and now you can see the prior data. Okay. Um, so yeah. So, anyways, you can see that we really took the fucking floor out. Okay. And if you look at the percentage moves, this is why I want to tell you guys that there is still possibility that even though we hit that 1.618 fib that I was showing you guys, that we can break that low again and go down for 5 waves, because back here in 2000 off of the highs, we dropped 40%, okay? And that was a 5 wave sequence down. One, two, three, four, five, okay? And then we had a 3 wave sequence back up. One, two, three. Okay. It's harder to see now because we're on weekly candles, but that just oop, that from the bottom rallied 40%. So we dropped 50%, right? And then, or, well, no. What do we, fuck, I'm already forgetting. Yeah, 45%. Nope, that's not right either. That's it. 66% is what we went to the bottoms, okay? And then we rallied from that 66% down, we went back up 40%, okay? And in total, let's just go ahead and flip this again. It's a short move anyways. From total to the bottom here in 2022 October, the market discounted 83% from the highs, okay? Now, you might be thinking to yourself, Jesus, 83%? That's a buy the dip opportunity. And it definitely was. But look how slow the economic growth was after this. You changed this parabolic equation where we were just going straight up to this linear sideways movement. Okay. And since 2002 to 2008, that's 6 years, right? And for 6 years, you only went up 184%, and that's if you got the bottom. And in total, if you had bought this .com bubble and just held throughout the entire thing, because people tell you, oh yeah, it's a long-term game. As long as you hold for 20, 30 years, you'll make money, right? Well, if you got to the high, would still be down 53% from the highs. Okay? So that's why people like Warren Buffett are trying to get out and they're selling all of their shares, because it could take a very, very long time. And Warren Buffett obviously doesn't have a lot of time. He probably has maximum like 6 or 7 years left in his life, right? And so there's no point in for him to be in the market. But you see how we rallied for the next 6 years, and then we had this floor get taken out of us again in 2000. And this shit this is why it was such a huge panic in 2008, because after rallying that 100 and something percent off of the bottom, we then drop another 50%. And everybody's like, the world's fucking ending, you know? And so that's why I'm saying, like, if we were to assume something similar to that happens, because there is a lot of parallels, okay? The parallels you can draw just for like quick analysis is that in 2000, we had all these worthless companies that were putting .com at the end of their name, and all of them were basically making a shit ton of money, and the valuations were astronomical, okay? And in this bubble, you have all these AI projects and agents and shit, and people making money off of shit coins because they're AI involved, right? And then they take that money obviously and put it in the S&P, right? Because that's what they say is the safe thing to do. Um, there's that. There's also the parallel of the fact that in 2008, right, we had subprime loans were absolutely out the wazoo. And now we have FHA loans that are out the wazoo. If you didn't know, FHA loans have it built into the law that if you go delinquent on them because you can't pay your FHA loan, they don't kick you out. It goes into the it goes into the debt, the national deficit. So it's like FHA loans have it pre-cooked into it that it's fucked up because they're offering FHA loans to people and I think 48%. I think the stat that I was looking at was 48% of FHA loans have defaulted. That the people who got the FHA loan are paying more than I think it was 40% of their annual income. So if you make, let's say you make 10,000 bucks, and the amount of money that you need to put towards it is, is 4,000, right? Then and you default, you're part of that statistic essentially. Okay. So, but anyways, the point being is that FHA loans are very, very similar to the 2008 crisis. So we have like a whole bunch of things that are really starting to brew here, and the FHA loans is going to take longer. Okay, that'll take longer for that effect. And so, likewise to 2000, you might see an 80% crash followed by the next 5 or 6 years we start to slowly incline, followed by FHA loan collapse. Okay, until eventually we go back up. And so, just to kind of put that on the chart here for you, what does an 80% decline from here look like? Yeah, so beneath the COVID lows for 80%. Now, we're being modest, both me and my dad, by saying that it would go to the COVID lows. Okay, because we think that that's where most of the market manipulation happened. That's when they printed a bunch of money. That's when they started providing stimulus and all this other stuff. The market was in a pretty normal state. Yeah, it was starting to go up kind of rapidly, but it's still kind of following like this linear, right? It's kind of still on this linear. But then when we print all that money, we go completely off the linear. And in 2022, here, we didn't come back to the linear, right? We stopped because there was this idea of slow unwind, right? That's what they were saying back then. By the way, I long term shorted it here and I got out here. Okay. So it's not my first bear market. I've dealt with this shit. It's not that hard. It really isn't. And you get a I mean, this was not anywhere near as volatile as this. Okay. But you're at we're trying to be modest and we're trying to say it's not going to be as bad. We have algorithms now, and the algorithms have been learning. And so maybe instead of 80%, it's only going to be 60%. Most crashes aren't 80%. You have to keep in mind that back here during the dot-com boom was kind of when people were still learning about computers. People were still learning how to operate the computer, and trading as a whole was just then moving over to the computerized idea rather than the on the floor, um, you know, old ways. So like at the computer, you have a lot more data right there in front of you. And so back here in 2000, they were still on the floor, and you have less data presented in front of you. You're kind of, more distracted and such. So that could have contributed to the 80% decline. And, we're trying to be a little bit more modest and not say it's going to go the full 80% because that'd be terrible, right? But, if it were to come to COVID lows, that's 70%. If it comes to the COVID highs, that'd be 56%. Okay, and you don't get those crashes often. Money Invest or whatever on YouTube, he has a pretty good video where he was showing how often it stays 50% off of the highs. And I think it's like for the past 25 years, it's spent like, I think they said like three days at more than 50% of a decline from the all-time high. So, yeah, it's not very long, but at certain points, it starts to become so oversold that if you are young, right? I'm only 27, well 26, but uh gonna be 27 soon. But 26 years old, so I got plenty of time left in my life. I could buy here, right? Long term in like a Roth IRA and be perfectly fine. It's a what, 20 something percent discount from here? 25%. Yeah, it's a great discount, right? But for some like for my dad, he's like 60 something, right? And so for him it might not make sense, right? Like for him he probably still would recoup his money if he lives long enough, right? But for him it's like you might as well wait until at least we get to these lows. And then from there it's like yeah, maybe you buy stocks, right? But at that point he'll be so old it's like what are you even buying stocks for, you know? I just showed you how in 2000 we had this slow growth afterwards, which is honestly a good thing. I know it sounds crazy, but this is the proper growth. This is real growth. This is overinflated bullshit propagated by the war machine. That's what that is. It's like this is them meddling in foreign affairs and trying to get foreign investments from people. And then this, after COVID, is the Federal Reserve quantitative easing failing. So, you got to be very careful. It's still, I know it's at a discount. I know it's 25% discount, but there is so much more room for it to move, especially if it's going to be anything like the 2000. Okay. Um, it's just, I don't know. I definitely wouldn't be looking to be long this market. And, this is something probably you guys already know, but you go to daily candles. This red line is going to be your 200-day moving average. Okay. When you come down below that, we're still uptrending, right? We were still uptrending on this 200-day moving average. This 200-day moving average acts as like a measure for some people whether or not we're in a bull market or a bear market. When this red line, when it curls down like that tells people we're in a bear market. But there's this thing called a rubber band trade where we were still inclining. This was still uptrending on the 200-day moving average, even though we passed it. So the market wants to springboard back to it. Okay. There's like it just naturally wants to move back to it to retest. It's basically saying, hey, are we actually trying to sell this the fuck off or not? So we come down and we come back up, and you get this 200-day moving average touch. And when we come back down below it and we fail to stay above the 200-day moving average, that was a clear short for a lot of people. And so that's why you got coming um coming off here, right? You get this strong movement down, and then they tried to one last attempt to double bottom it, even though, it technically broke the low, swept the lows, whatever. They try one last attempt, and as soon as it crosses back down, crosses this point here, it's just a free for all sell. Everybody knows at that point. Okay. And again, that's if you wanted to bring it into Elliott wave terms, that's one, that's two, that's 2-1, or I mean, I'm sorry, 3-1, 3-2. And as soon as you break these lows here, everybody knows it's a 3-3. And so at that point, everybody's like, fuck, sell everything, sell it all. Okay, they're like super panic selling, and if you look at the CNBC Fear of Greed Index, we're at like astronomical lows. I think we're at like 4 or some shit like that. It's like very, very fear. So we got these massive sells, 5% every day, right? And then we get this fake news event. The fake news was the only thing supporting the market. Think about that. Think about that for a second. For all these people that were telling you, oh, this is the bottom, this is the bottom, They're telling you that based off of a fake news event support. So people that trade fundamentals like Warren Buffett, okay, who if he has all this cash on the sideline, if he redeployed it back in, yeah, that would definitely affect the market, right? But is he going to invest solely based off of this technical movement, right? This technical movement back up? No, he looks at fundamentals of the economy. He says, okay, the prices are still overextended here. There's no real value still. It could still come much lower. What's the point in getting in and rushing into the market? Right? He might have deployed a little bit of cash into that. He might have, right? He might have thought, "Oh, this is a good opportunity to squeeze shorts." Maybe, I don't know, but he definitely wasn't putting all of his money in. And when that came out as being a fake news event, and we still supported the lows, we kind of like consolidated in here. That was like to me like a clear dead giveaway that this was a wave four of three, right? Because how is it that the low is going to be supported off of a fake news event? It's not even real. Like that doesn't seem fathomable that a fake event that is completely arbitrary. It's not like there's some sorts of like support here that made everything like on long-term technicals. It's not like it made it go up, right? There's no support here. There's no support. It's just like some made up fucking level. Some guy posts a fucking tweet or some shit and then they announce and it goes up. It's like and there's no reason you should be thinking that support's going to hold. Of course it's going to break and it's going to at least retest that support, right? So there's no reason that anybody should have been longing that. Now, the opportunity on that day, I saw a lot of they posted their gains and shit, and I get it. I mean, that was even my father, who's been trading for decades, he told me, he was like, I don't think I've ever seen a short squeeze like that. Like, this is insane. 480 all the way up to 523. And that was from 943 until 1018. So in like 25 minutes, you fucking rallied like 40 points. Like, imagine if you had 0 day expirations at the money here, long, you would have been up a fortune. Like you probably got those 0 day expiration longs down here for like since the volatility's high, you probably got them for like I don't know, like $300 a piece, and up here they'd be worth 4,000 a piece. Like that's insane. And so I don't know. I think it's very overcooked. Oh, that's interesting to look at. So I mean, I rarely look at the SPY. I'm pretty much a purely Nasdaq, purely QQQ. But when we're doing the same thing, right? We know that this was like a flat. But remember what we were talking about before was just you could consider on the QQQ or the Nasdaq, you could consider that either just a normal flat, or it could have been a running flat on the QQQ. But here on the SPY, it was um, I guess an extended flat because it comes a little bit further than past A, right? We broke over that high. So that's something that's interesting. So again, that'd be one, two, three, or no, one, two, three. And then from this bottom here, you'd go one, two. Oh, and one more thing I guess I didn't mention, even though this is basics. Two can't come below the origin point. So like the origin point where it was zero, two can't be below that. That invalidates the pattern. Has to be like, a stepping stairs up. That's what Dakota would call it. He'd be like, "Oh, you're making a higher low, a higher high, a higher low, a higher high." That's the very basic, like, I'm a toddler and I don't know trading. That's like the basic normal normie. It's like level one. And then you get higher up and you understand, okay, well, It's not just a higher high and a higher low, it's also the fact that there's volume that's increasing on this movement. And then you get to like a level 3 where you start to understand Elliott wave, and then level 4 where you're like looking at like heat maps and stuff like Rips used to. You know, you have the book map or whatever and you see, hey, there was a big support here where people bought it back up, right? You say, okay, well that's gonna send the market back up. And yeah, you see all this stuff on the heat map and shit, and then, you know, you have ICT, which is like negative level. -1 ICT. All you need is one more line, right? And you get your eye. Nah. But yeah, I don't know. That's pretty much it for Elliott Wave, just the basics, you know. But it doesn't really get that deep either. That's the thing. It's a fairly simple strategy. It's not super complicated. It might seem at first, but the reason why I say it's simple and you know it's simple is because it's literally pre-cooked into your trading view. All of this shit you should understand. It's literally preloaded onto your platform. So what is holding you back from learning anything about this, right? You should know all this stuff. So like with the pitchfork, okay, here's something for you. 30-minute pitchfork. So on this pitchfork, go from here, right? You get that higher, you connect the highs, and then you can connect down to the previous low, right? Which is here. And now you have yourself a nice little support, right? And it's telling you that it should on a nice steady decline stay within this green channel. And when it doesn't and it peaks like down here, right, where we peaked underneath of it, well, I didn't draw it perfect, but we still did peak underneath of it, right? That was a decent time to buy based off the fact that we were oversold. Okay, and then you could have caught that crazy news event bullshit. Okay, so little things like that, you know, there's no reason why you shouldn't know all of this stuff. You should know all of it. I mean, some of this stuff is useless, like Fibonacci spirals and shit. Like, the fuck, you know, like some of this stuff was really useless. Um, you have Gan, whatever boxes, and what's her face uses that. So you probably already seen that if you watch Top Step TV a lot. Um, all this is Elliott wave stuff. 3 drive pattern is basically your triangle, and they're just measuring the space between each low. You got your head and shoulders. Everybody in the world, I think, feels like they know that one. You got, you know, all this shit. Triangle pattern. So it comes. That's nice. I didn't even know that this was there. I just usually use the Elliott wave stuff, but it automatically puts on your triangle for you. That's nice. Cyclical lines. So this is just giving you evenly spaced lines. You should understand all this stuff, right? It's pre-cooked into your platform, so understand it, you know? That's what really drove me to think about Elliott Wave was like I was looking at this shit and I was just trying to learn as much as I possibly could. I'm like, well, there's a whole fucking section committed to Elliott Waves and I don't understand what any of this fucking shit means. Triple combo waves. So I looked it up, figured it out. Then I found out that my dad uses it all the time. He's been using it for decades. He pretty much taught me the ropes. But yeah, you know, you should be definitely learning all this stuff. Anchored volume profiles. I use these. Um, there's a nice trade that you can use on. Let's see, 1 minute. So if you go to QQQ and you go to the 1 minute chart and you have a fixed range one, and you go from the open today to the close today, okay? And then you click on the settings, you can get this value area high, value area low. Okay, you can also get POC, point of control. And what that's basically showing you is where 70% of the volume for the day was traded. That's going to be this highlighted section, and also where these purple lines go. And then the point of control is where the most volume was traded in that day. And so there's a trade that you can take. It sometimes works. I don't know what the accuracy of this is. I saw some guy online said it was 70%, but I think that's a bit high. It probably isn't. Um, but we actually executed it today. Okay, so you take the previous day's value area, so yesterday's value area. Okay, and if we open outside of that value area, which we did, we opened up here, and then we come into that value area, you take a short. Okay, and then you ride that short until we reach the other side of the value area from the previous day. So you can see that obviously worked out. But something I've kind of noticed about that is that it'll oftentimes reject after going in. You can see that we went in here, it rejects and comes back out. And typically the second time you come through. So right here, right, is where you can get a nice short entry. Again, though, it comes back out over here. So it likes to manipulate around with this idea. So you need to have, I guess, a pretty wide stop. Um, I think it'd be advised if, like, the first time that you broke was here, right, during this decline. I think it'd be advised to put your stop at the previous high, so here, and then you'd be safe, you know. But then you'd have to have a pretty wide stop because every $1 on the QQQ is 80 points in the Nasdaq and on the NQ. So, if you do the maths on that, when you got in was 420, let's say 428 just for sake of argument, and up to 433, you need to have like you know, you need to have a good long stop. It's like 350 points. So, you don't it doesn't necessarily work the greatest for futures, but like for options and stuff like that, sometimes it can be really useful. Because obviously, if you had taken the short here at 427 and wrote it to the value area low down here at 416, you make 11 points worth of delta, or well, alpha, I guess. And let's say you had bought the at the monies, then basically when you get 10 points in the money, then you start to be at full delta, and so you probably would have made a shit ton of money off of those 0 days, but of course, you would have had to hold through all this mess, which can definitely get you, your panties in a bunch, and it doesn't work all the time. I've been noticing that recently it's been working less and less, but today it was pretty obvious that when we came in, and um, I have some indicators I use, but uh, everybody loves their opening ranges, 15-minute opening range. Um, this was the other reason why I took my short earlier today. When we came up here, we broke up and then we came back down and we broke low. When we did not come back over the halfway point here and we broke back down beneath, I was like, okay, it's probably a short. Okay. But I didn't take this one, even though that was probably the best short to take, was right here. You already had the confirmation down here, and then you had the EMAs crossing back down. You had us breaking back down beneath the opening range low. There was a lot of confluence there that we were going short for the rest of the day. And then the other thing was that we broke into the gap. So the price gap we broke into, obviously already broke into it over here, but we broke back into it and we ended up going even further extending. So, when we bounce back up here and we reject now the opening range low and we're using that as a resistance. It comes down, comes back up and tries it again, rejects off of it again. That's where I entered my second short, was like when we came back up, rejected, so somewhere like around here. And then, we come up a third time and reject. I was like, okay, well, three times rejecting off of one resistance. You could also consider that, I guess, on like a very, very micro scale. You could look at that as being some sorts of head and shoulders, right? Coming back down, you break that low here, and that's when it really starts to take off to the downside, right? Okay. And so, opening range can be very useful. Um, you don't need ICT, is essentially what I'm trying to say to you guys without saying it. I Okay, I gotta be fair though when I say that and I say ICT is bullshit. I only say that because everybody that I've ever looked at who uses ICT is unsuccessful. It doesn't necessarily mean that it doesn't work. Maybe it's just that they are over leveraging and whatever, or maybe they don't have proper discipline, or maybe they're looking at too small of a time scale. I don't know. I don't know anything about ICT. But, I'd be open to learning about it. I'd be open to like, hey, give me some of the basics of ICT. What the fuck is an SMT? That's the one I always see. Oh, there's a 5 minute SMT here. There's a there's a 2 minute fair value gap. I'm just like, what the fuck are you guys talking about? The only gaps that are in my vocabulary is that's a gap. Price closed here and opened in the morning here. That's a gap. Like you'll see it sometimes on a super small scale. Like here, for example, right? You closed here and the next candle opens down here on a 1 minute. So that's like a little small gap here. And of course, the next minute comes back up and fills that gap. It's like, yeah, like usually that should tell me that there's some sorts of like overextension, especially if it happens at the bottom of a move. But like here, for example, right, I wouldn't consider that the same thing because we open here, or I mean, I'm sorry, we close here, we open here, but then we extend it up, so we basically filled that gap and then kept going down, right? But here is a little bit different, just because of the fact that we opened down here, opened here. We did come back up. We could have continued going back down, I guess, but I don't know. It's just I don't know. But those are like little small gaps in the chart. They don't really count. Real thing for gaps is just the open to close. Shit, bless me. I had to sneeze. But yeah, you had the gap yesterday, you had that filled. It doesn't always fill, but it likes to get filled. On these big 5% down days, right? You didn't fill that shit. You didn't fill this shit. But it gives you places to kind of aim for. And today, for example, I have on my Thinkorswim platform, I have like an indicator that I've programmed within like an algorithm and stuff, and it'll give me price targets for. It'll give me two take profits basically. It'll give me an entry, a stop loss, a take profit one, take profit two. Take profit, I think entry was like right about where I took it was, which was here. So I was even more like confidence for my short position earlier today. But take profit one was down here, okay, and take profit two was at 415 something. It was at like the low of this consolidation area. And I was saying to myself, I was like, dude, if we fill this gap, there's a chance that, they try to just buy this up. And because the way I was looking at it from Elliott wave pattern was maybe this is a wave three. This is one, two, three on a bigger scale, and I'm just not counting it right. And I was thinking maybe it's like some sorts of the one that we didn't go over, the double three. That's what I was thinking. Maybe it's a double three. Double three is just again here. If you look at this picture, let's blow this up. You can see that we have this ABC, and then we have again an ABC going to X, and then for Y, right, we have a 5 wave, 3 wave, 5 wave. So we had a zigzag within three. Okay. So it's showing you a combination of a flat and a zigzag. Okay. Because obviously you had the 3 waves up, 1, 2, 3, right? Followed by the 3 waves. Uh, you get it. It says here flat, any three, zigzag. Yeah. So, anyways, I mean, you have the flat and, or no, you have a flat and a triangle here, right? So this is all a flat. And I guess technically where they're marking the flat, that would be considered a extended flat, right? Because it extends lower than A. So that's an extended flat, and then any three going back up, and then the triangle. You have 1, 2, 3, that's one. 1, 2, 3, that's two. 1, 2, 3, that's three. 1, 2, 3, that's four. 1, 2, 3, that's five. That's it. Right. So that's a double three, and then you have your triple three, which again I don't think that really happens very often, but you can see we have a flat in there, we have an any three, and then you have a double three, and then an any three, and then a zigzag. So this is basically showing you that the flat is just part of A, right? And so then we go back up for any three, and that's just B of A, okay? And then we come down for this, and that's your end of A, and then B, and then C. Okay, so and C has its own extended. So it's all just, it's a little bit fucked and everything looking at these triple threes and the double threes. It gets more complicated when you get into that. But again, you don't really see that as often on like a 1 minute or 5 minute chart. So if you're a day trader where we have to close our contracts out at the end of the day anyways, then you're probably not going to run into many of these triple threes or double threes. Most of the times, it's going to be, some sorts of just zigzag or flat. Um, so, let's go ahead and look at the market where we're at right now. I would trade right now and just try to show you guys a quick trade type of thing, but like I said, my account's being fucked with right now, and so I have to wait until they fix this problem. They said it can take up to 2 days. So, and they said don't trade it until it gets resolved. So that's why I'm not trading it. It's fucking annoying. And then of course my XFA got blown today off of that bullshit. I'm sure that'll get resolved too. Just absolute bullshit. But yeah, looking at this, where were we when we started this whole explanation? Uh yeah, so this is where I was calling the low. Uh So we got a 1, 2, 3. That's A, and then B. 2, 3, 4. No, can't really be 5 waves up, right? Because if we zoom in here, this is 1, 2, 3, 4 goes into two. So that's not possibly a five. So since we know that's not a five, it has to be a 3 wave. And since it's not a five, okay, since it's not a five, where is it? There it is. Since we know it's not that first five, then it has to either be a flat or it has to be a triangle, right? So this could be 3, and then 1, 2, 3. That could be another 3, and then 1, mm, 2, 3. 1, 2, 3. No, that doesn't look so much like the right pattern. I think this is probably like a 3, 3, 5 flat. 1, 2, 3, 1, 2, 3. Yeah. And then 1, 2. Nope, because then 4 comes within 2. So this is going to be some sorts of double. Yeah. Right when I say you guys won't have to deal with it very much. It's going to be something like a double or a triple. So 1, 2, 3. That's definitely a 1, 2, 3. I don't have to worry so much about that. So we can label that. Okay. And we got 1, 2, 3, which would be a flat. Okay. Right? No, yeah, it'd be a flat that'd be extended. Be an extended flat. No. See, like this is why I don't necessarily like to trade corrective waves because you'll be sitting there for a while trying to figure out what exactly is going on. Um, it makes it a lot more difficult. 1, 1, 3. Huh. The thing that I'm thinking is that this could be wave A, and then you get 1, 2, 3. That'd be part one of B, and then 1, 2, 3. That'd be part two of B, and then 1, 2, 3. That'd be part three of B. And now we're starting wave C up. Okay. And wave C, if that's the case, and this is 3 waves up, and like I was saying, this is overall, fuck all the in between waves, like that. That's another 3 waves, right? So 1, 2, 3, 1, 2, 3. Then you should have 5 waves going up, or a triangle where we're going to continue going sideways here. And the triangle breaks in the direction that it came into it. And so the direction we came into it was down. So you'd expect the triangle to break down, which wouldn't really be, we expect it to go down. We expect it to break the, well, like here, extended. Well, I don't know why it's taking so long. My computer's taking forever to load. So, like, we already broke the lows here. So it needs to break these lows because that would finish wave 3, 5. Yeah. On a bigger time scale, like I was saying earlier today, that's 3, 1, 3, 2, 3, 3, 3, 4. Okay. And so if that's 3, 4, and this is where we are to as of today, then 3, 5 should break these lows, right? And that's just the end of 3. At that point, we no longer say 3A, 3B, 3C, because then that ABC would just be a part of the larger wave 4, right? So we just say wave 4 going back up. And we try to discern when that ABC is over going back up. Then you could trade that extension down.
which is like the overextension. Okay. So always on a wave five, you want to take your profit faster. Um, so like when we break these lows and we finish wave three, which again I think wave three will uh so when wave three of three ends, that's what we're trying to say right now. Right now we're in wave three. One, two, three. Yeah, we're still in wave three of three, but that goes even one more time scale down, where it's a 3-3-1. Because the larger time scale here, that's one, two, three. That's the first three, right? And then this down would be part of 3-1-3-2. That's the second three, 3-3. And then the rally on the fake news and up to the high today would be your 3-4. And so when we break that, that would be your 3-5. Okay. And so at that point, you no longer have three time scales. You're only going back down to the two, right? So now we're at the end of 3-3 once we break these lows. And then we'd be doing 3-4. And then we break those lows and we'd have 3-5. No, I'm sorry. I said that you motherfucker, man. This is why it's sometimes easier just to put it on the fucking thing, dude. One, two, three, four, five. That's what I expect is the bigger wave count, okay? Within wave three, you have one, two, three, four, and we're gonna break these lows. When we break those lows, we'll finish wave three, okay? And then we'll get a larger ABC, and then we'll get another five waves down, okay? And then that could be your end, okay? That could be the end of the bear market and we go back up. That could be your zigzag, right? Because this could be five waves down in here, okay? And then three waves back up in here, and then five more waves back down, right? So that could just be your zigzag, and that first five, this one is really just an A, and this two is really just a B, and then all of this down to five is just your C, okay? So that's a possibility. That's the best case scenario. Okay, if you're a long-term bull and you have a 401k and you want the minimum pain, that's best case scenario. Okay? However, it's worst case scenario really because that just means that nothing got solved and prices are still going to be astronomically high. You're not going to be able to afford a home. You're not going to be able to afford stocks. You're not going to be able to afford shit because everything's ridiculously priced. You'd actually rather have the market crash because then you can put your money in at a really large discount. Because, like I was showing you in 2000 earlier, you get 120 something percent in 5 years, you know? Then you'll have another massive crash in 2008. There was a massive crash again, but, you know, you get your money in there at the very, very bottom. I didn't even go and show you guys that. You know, let's say you put your money in 2002 at the bottom here, and you held through 2008, you held through COVID, all the way up until now, right, at these astronomical highs. So somebody like Warren Buffett did that, right? If you had done that, you'd be up 3,100%, okay? So, I mean, let's say you put in $50,000, right? times fucking what, 31, 32 times? That's 30 times. Times 30. You have 1.5 million off of a $50,000 investment in 2000 or 2022. I'm sorry, 2002. So 2002, so it'd be 23 years, you would have made 30 times your money. You know what I mean? So that's what we prefer if that happens. As investors, as somebody that watches the market every day, you prefer if it goes down because it just means you get to buy it at a better price, right? Now you don't want to blow your money, right? If you have your money in the market already, then you're looking for one of these bounces, right? Like this bounce here so that you can take your money out and you still made a shit ton of money from all the way down here, right? If you took your money out and you didn't get the exact high cuz you can't expect to get the exact high. Even Warren Buffett didn't get the exact high. But, let's say you waited until you had the confirmation that you were done. 487.70. Yeah, you still would have made fucking 20 times your money, So again, doing that math with 50K, oops, still make $1 million, right? So that's what we want as investors. We're sitting here and we're like, damn, like I can't get any value because if you invested up here at 500 something dollars, right? For you to make 20x your money, let's say you put 50,000 in there, right? You'd need an astronomical valuation. It'd be ridiculous, right? Like if you needed, like, look at that. It'd be an astronomical. Even if we went up, like, look at that. Like that's the amount of, like that's ridiculous, right? We went up that much, and you're only up 3 times your money from here. Right? It doesn't fucking make sense. It's not going to do that, right? It's not just going to explode up. So there is no real potential to flip a lot of money in the stock market right now. That's what Warren Buffett's saying. For you to get to 20x your money from the top there, the QQQ, not even the Nasdaq, but the QQQ has to be at 11,600. And the QQQ is 80 is the Nasdaq divided by 80. So 11,600 times 80. You would need the fucking oh my god. That's what you would need it at. That's insane. We're at like 17,000 or something like that, right? 17,000. We would need it to be at 928,000 for one share. That's just not going to ever fucking happen, you know? Like maybe like fucking like our country will have probably collapsed by then. It's not going to fucking happen. Like it's just not going to happen. So there's no value up here. No point in putting your money in. That's why we need a crash. So you don't sit there and you say, "Oh, Trump this, Trump that." You don't make memes in the fucking Discord like all these idiots that are sitting here saying, "Oh, that Trump's an idiot or Trump's a dumbass." Dude, he's doing you guys a fucking favor. And when he keeps saying, you see these memes, "Oh, is this what winning feels like?" and everything's red on the heat map. Yes, it is what winning feels like. It is. It is exactly what winning feels like. That's another parallel, by the way. Republican president in 2000, Republican president in 2024, Republican president in 1987. Okay, you want to crash? Put a Republican president in there. It's a good rule of thumb. You want one of these? One of these slow unwinds, which just makes the problem larger? You put a Democratic president in there, and he'll do that for you. He'll work with the Federal Reserve to deflate or to inflate the dollar to make the dollar worth less and put the money in the stock market so that I can make a profit. So, you know, don't listen to all the hype. Don't listen to the news, man. None of this shit is political. It's not political. It's all economic. It's like how much money have we given to other countries? We've given so much money to other countries. It's ridiculous how much money, and this is taxpayer money, which we don't even have. That's why we have a deficit because we don't have the money from the taxpayers to pay for those overseas debts. So, I mean, you got to think about that, man. That's why we have 33 trillion in debt and we're in this debt crisis now. Okay? So that's why he's raising tariffs because he's like, we've given you guys so much fucking money and we've never returned, you never returned shit for us. You've given us some trashy fucking clothing from Timu that fucking, disappears within a fucking one wash. you know? I don't get people. I think that they don't completely get what's going on. But you got to be careful in these markets, that's for sure. The volatility is huge, The VIX is the measure that you want to look at. Um, so yeah, anything like above 60, that's going to be like very, very high. 2008, you were above 60. COVID, you were above 60. So that's going to be your levels there. Got to be careful in the high volatility markets. All right, I'm going to go ahead and call it here because nobody else is watching. We got all the last people out. I had to keep yapping until eventually everybody would leave. That was the goal. I don't often have viewers, so it's like whenever I do, I have to keep yapping until they leave.